Calling to order Silicon Valley Clean Energy Finance and Administrative Committee meeting of May 5th, 2026 to order at 10:07 a.m. And we have roll call, please.
Yes, Committee Chair Srinivasan.
Present.
Director Risto. Here. Director Makachek.
Present.
Thank you. We have 2 absent currently, but we do have a quorum of our committee.
Thank you. This open for public comment. Public might provide comments on any matter not listed on the agenda, provided that it is within the subject matter jurisdiction of SVCE. Speakers are limited to 3 minutes. Are there any public in person or remote?
No hands raised to make comment. Sure.
Okay, with that I close public comment, bring it back to the committee. We have, the next item is consent calendar. And we have a motion or a comment to approve the consent calendar, approve the minutes.
If you take public comment on it, then I will make a motion.
Okay, sounds good. Is there any comment from committee members?
Me.
Okay, with that, I open for public comment on consent calendar. Is there anybody in person or remote wishing to speak on this item?
No hands raised, Chair.
Okay, I close public comment on consent calendar, bring it back to the committee.
I'll make a motion to approve the consent calendar.
So, second. Okay, with that, can we have a voice call or a roll call or just?
Yeah, I think at
roll call.
this
So,
point,
yeah,
yeah,
I
since
can-
everybody's
yeah.
here.
All in favor, raise your hand.
Aye.
Any opposed? None opposed, none abstained. Motion carries. The next is CFO update.
Okay, so
Go ahead.
one thing I want to share is share the audit committee starting is the audit committee met last Tuesday. So they finished the audit of the fiscal year that ended September 30th, 2025. They issued a clean audit. And also they did not identify any material weaknesses in the controls. So that audit committee the audit committee voted unanimously to accept the results of the audit and made a recommendation that the board accept the audit findings as well. The auditor will be present in next week's board meeting to present the results to the board, and we will release the financials, post them on the website after the board meeting. So that was one update. Another update, last time when we met, we talked about GASB 96. Returning members will remember. So we have implemented GASB 96, even in the financial statements that were just issued. One thing we had talked about was adopting a policy and asking the finance committee to review and then recommend that to the board. I had mentioned that we may do so at this meeting, but we're going to push it out to the May meeting because we had too many items coming to this meeting. So we'll do that, and there's no consequence as long as we adopt it before the end of the fiscal year. That policy would still apply to the current fiscal year. So we'll do that at the next meeting. Okay. Other than that, I did not have any other items.
Thank you. Any comment from committee members?
The question is, am I still on the audit committee? The answer is yes, and I will resign as soon as the meeting is over next week and the audit committee reports the results to the board. And then I think it would be great if we had 5 people on the audit committee. I think it would be, the reason I say that is I was constrained last year, if you will, because I couldn't speak to anyone else on the audit committee, right? Because that would be a Brown Act violation. So if there were 5 people, then 2 people could at least have a conversation. So I think we'll be I from a governance perspective, I would advocate that we recruit another person.
For the audit committee?
Yeah, and it's anyways.
Is there a problem if a member is both audit committee and finance committee member?
I don't think there's a problem.
Yeah.
I think
I
it's,
think so too.
Yeah.
But,
There-
there's nothing in our rules that prohibit that.
okay,
I think it's just maybe the concern that Director Mekachek had was that you want to separate the two.
absolutely.
And I would underscore that and say, in our governance, it should say you cannot be a member of the audit committee and be a member of the finance committee, because you can't.
Yeah, you can't do justice to one or the other.
But our current operating rules and regulations don't prohibit it. My suggestion in terms of your suggestion, Director Mekachek, is that perhaps we bring that up as new business at the board meeting to have the board consider adding a fifth member to the audit committee.
For the next meeting?
Yeah, under new business, when we.
Yeah, let's think that one through a little bit, because there's some other changes that I would like.
Yeah, this group doesn't decide that though.
Yeah. Oh,
Sounds good.
I- absolutely.
Yeah, then we don't have to.
Right, board does. Okay, the board has to decide that.
Yeah. Okay, with that, I close the agenda item CFO update and bring it back. For the next agenda item, elect chair and vice chair of 2026 SVCE Finance and Administrative Committee. Interested board members will be asked to self-nominate, or others can nominate for the role of chair and vice chair. Is there any nominations? Even self-nomination is fine.
I mean, I was thinking we didn't meet a lot, we only meet quarterly, so I was either gonna nominate you to do it again or Director Mekachek.
If you wish to continue as the chair, I would support that. I would then like to nominate myself as vice chair, but if you wish to be vice chair or whatever, I'm good, whatever you want to do.
I think we should constrain it to the people that are here.
Yeah.
too.
Of course, of course.
Obviously, and then, yeah, exactly, and then having the person in absentia doesn't make sense, because the person has to accept the nomination. I am okay with serving one more year, and then
Hey, then I'll nominate you as the chair.
I accept nomination,
Second that,
okay?
and then nominate you as vice chair.
Can we have a roll call
No,
vote?
We only need roll call if someone's on Zoom. And we don't have any members on Zoom.
Zoom, on Zoom, yeah.
So if we're all here. it's
Yeah,
just-
we are all there, yeah, we just voice vote. Okay,
Okay,
thank you. And then now I nominate,
I accept the nomination.
thank you. Second. Once again, say hi.
Aye.
Hi. Okay, thank you very much. With that, we move to the next agenda item. Recommend approval of change SVCE fiscal year period from October to September to calendar year period effective January 1, 2027, and other necessary changes to allow the implementation of new fiscal year. The staff report.
Okay, so as it says, we are proposing to change our fiscal year to calendar year. I will go through why we're proposing this change. And I will say that the executive committee met on this last Friday, and then the audit committee met last Tuesday. And we took this item to those committees as well, and those committees unanimously supported this change. So I will go through some of the highlights of the timeline and processes. This also would have been introduction somewhat to our new members as to what we do with this committee and the expected times when we meet. So I can go through this quickly since most of you are quite familiar with our process here in the finance committee meeting.
So we don't have the, Chuck Page would be new on this committee and he's not here yet. Okay.
Okay. So anyways, our
You
fiscal.
are also new, right? For
I
this
was on the
committee.
finance committee years ago.
Oh, okay. So you know the process.
Oh, yeah.
So what we're proposing is to change the calendar. The primary reason we want to do this is to adapt to our rate changes, customer rate changes, as the committee members, We take the budget in September, we have to redo it in December when we have better information on PCI and PG&E gen rates. This basically avoids that unnecessary change, and there are also many other benefits because it aligns very well to a lot of our internal planning deadlines, and a lot of our compliance obligations also tend to be on calendar year. And the JPA, as noted on the slide and the staff report, allows us to do this, and we have done this once before. Okay, so here you can see this is what we do right now. We usually do it around February timeframe, basically to review the mid-year budget. And then also at this time, we go to a refresh of our ERM process and enterprise risk management. We propose stress test proposals, which Scott is going to do later in the presentation. And then the audit committee, obviously, as I mentioned, reviews the audited financial statements. And then in May, June, we bring back the stress test analysis. We go to the board with that. You remember that analysis basically shapes a lot of how we manage risks, as well as how we assess the adequacy of our reserves. So it's a very important exercise we go through. And then in August and September, based on all those planning work we have done getting to that point, we also update our entire budget. And the current budget policy says we have to preview the budget 2 months before the end of the fiscal year, so that happens in August. And then we present the annual budget in September. And then, as I mentioned, in November, December, we basically refresh or update the budget. At that point, we internally call this mini budget. Primarily, we're updating the revenues and power supply costs. And the revenues are severely impacted because then we don't have the final, but we have much better PCIA and PG&E gen rate forecast information. And as you can see, those are the times that correspond with generally on a planned basis. Of course, the committees can meet as often as we need to, but February, May, August, and November, primarily around our budget planning and our budgeting process and risk management processes. So with the proposed timeline, if you go to a calendar year, basically things shift, right? So what we did in February goes to March, May, June timeframe. And then the stress test analysis will now occur in August and September. And November is the time when we will bring back the annual budget, so we don't have to redo the budget. It saves time in staff time, committee time, board time. So the key change, however, we asked in the budget policy is that the requirement to do a preview 2 months before. So with this timeline, we won't be able to do that because starting mid-October to mid-November is when we get the updated information, and that's when we were basically putting together the budget. It's very time intensive. We don't have the information actually by the time of the board meeting in November to do a preview. If you did a preview, it would be meaningless. The numbers would be drastically different and would be a lot of wasted time. So we're asking that we don't do the preview, and usually from years of experience, nothing usually changes between the preview and the final adopted budget. So we're not missing anything. So that's one change we're asking. And you can see the timeline for the new finance committee meetings. We still want to target at least one meeting on a planned basis a quarter. So the February, March, even though there's no planned action items, we still want to meet, and we will do a high level sort of a mini budget for the finance committee where we will update true up to what the final rates were versus the rates we forecasted in December, and how the finances stand at that point. And then any other items we'll also plan to bring to the committee. And then all the other dates basically correspond to all these activities that we normally do. All right, so to do this fiscal year change, it does require a transition period. We're proposing a 3-month interim transition period called a stub period from October 26th to December 2026. Because as you know, our current fiscal year and our current approved budget will end September 30th, 2026. So we need a transition period. We call this the stub period. So we ask that the board approve this 3-month budget in September. And then we'll follow up in December with the full proposal for the first fiscal year under the new fiscal period. So that would be in December of this year, and that would cover January 2027 to December 31st, 2027. And then we're also asking the board to allow the auditor to conduct a 2-period audit covering the stub period, as well as we don't want to do all that work for 3 months. And this is pretty customary when fiscal periods change. And we have done this in the past when we changed fiscal year to early, startup days. So that's what we're asking. And so that's and the change in the budget policy that I already mentioned. Instead of a 2-month preview, we're just going to bring a final budget for the fiscal year, for the new fiscal year in December. So 1 month before the end of the fiscal year, we'll bring the budget for board's approval. Okay, so specifically, these are the 4 things we're asking the board to approve, and we're asking the finance committee to recommend that the board adopt. That's the new fiscal calendar year period, interim step period, setting the budget for that in September, combining the step period audit with the first audit of the new fiscal year, and amending the budget policy to remove the 2-month preview. That's there right now. And I'll take any questions.
Thank you. Is there any question from committee member?
I have a comment, not a question.
Okay, go ahead.
But if you want to take public comment on this.
Well, first we'll.
Oh, okay. So my comment is, Amrit has gone through the same presentation. This is the 3rd time, and I saw it on Tuesday, Wednesday, Thursday. My memory may be short, but it's not that short. So, and we approved the identical recommendation, the audit committee. And I think it's commendable that, first of all, that we're going through this change. The second thing is, in terms of everyone being on the same page, and speaking of Page, I think Chuck Page is arriving now. And what Amrit is doing is gaining consensus and understanding in small groups, so that when it goes to the board, everyone's like, okay, got it, I understand, and everyone's got faith in it. So well done. And I think the benefits of this are significant. And I think they're even more so than what were described. This is a very, very good thing for SVCE. Those are my comments.
Thank you.
Yeah. I mean, similar comments. I think, at our last meeting, it was kind of discussed that this would be coming forward. And, given that PG&E rates are set after our budget is done, we've got this whole shuffle to go on. It definitely makes sense that we would not have the 2-month preview, because we know everything's going to change. And in fact, before having a 2-month preview, setting a budget, and then having to shuffle after there was new information in December, you still kind of got that uncertainty. So this makes a ton of sense to me on every level.
I know you just
No
okay. So I have a couple of questions. One is, I like the term stub period. I don't know, somehow sticks to me. So for the 3 months, the stub period from October to December, do we expect any change, or is this operational budget, or?
We will bring a budget, we'll only forecast for those 3 months.
Okay.
So there won't be any uncertainty on the rates, unless PG&E change, they can change rates anytime.
Right.
Usually they change rates in January, right? Sometimes they can have, but they announce it up, like in 2024, I think they changed it in January and in July, but we knew what the changes were. So we don't expect any more changes. So the revenue, there won't be much revenue uncertainty. Power supply, any day we update because market prices move around, that number will change. And then if we have any other, we'll update the operating expenses for the 3 months for the department expenses. And I don't think we'll have any headcount, any of those issues. Obviously, the employee compensation, we usually review around that period too. So we will take a look at all of that.
Okay, thank you. And then when I read the report, not the presentation, it said that previously it changed to, I don't know which year, from I think July to October 1st. And then I like this change, by the way. That is not the comment, but my comment was why it was changed to October 1st and then.
My understanding it had to do with loan covenants that were taken at the start of. None of that is applicable now. So that's what they had to do with. It had to do with the startup period. That's when it was changed.
Okay.
Yeah.
And then this makes ton of sense, as the Commissioner said. First of all, tax preparation itself is much easier. Sorry.
So one clarification I will make, we took this also to the executive committee. I think I mentioned that they also unanimously supported the budget. The fourth item, obviously, we did not take to the audit committee because they don't make those recommendations. We're only brought it to the executive, finance, and we'll take it to the board. Obviously, it has to make all these changes.
That's a good point. So the 2-month period doesn't change, right? Or is that?
2-month preview.
Yeah.
We're asking to change the budget policy. We're no longer going to do a 2-month preview of the budget before the end. We're just going to bring a final budget one time in December for the fiscal year. And then we will always do a mid-year adjustment that will now be in June. That would be the mid-year.
I don't have any more questions. And then with that, I open for public comment on this item. Is there any public in person or remote wishing to speak on this item?
No hands raised.
Okay, thank you. With that, I close. And then this is an action item, so we need it. Okay, sorry.
We don't have our items up there, but.
Yeah, yeah, thank you. Who wants to make the motion? And
So-
second? Okay.
What I was gonna say is in item number 3, it's the 3-month, not sub-period, it should be stub period, correct?
Oh, yes.
Yes.
So I would approve the motion with stub period because I think it's just a typo. But if you want to make the motion,
No, that's fine, I'll second.
okay, so I'll make the motion.
Okay. All in favor, say aye.
Aye.
No abstain or no, motion carries. So thank you. Next is item 5, recommended approval of fiscal year 2025-2026 mid-year adjustment operating budget. Any staff report?
Okay, so you had a staff report and you had a presentation. I will go through the presentation, honestly. So this is our mid-year budget. As we do every year, we bring back a mid-year budget. We're asking that you recommend that the board adopt the new adjusted budget now. So I will go through the highlights from this budget, mid-year budget, to the one we showed you in December, to the board in December. We'll compare key line items, basically the main change, any the true up from final rates to the rates we projected for PCIA and PG&E gen rates. We're also providing a 5-year projection. As you remember, we're projecting some headwinds so the data is showing right now that as you'll notice that trend continues. So this slide basically gives a whole update of the mid-year budget. So the main story is that the negative 5-year outlook that we have been projecting for a while now, that trend continues. It actually deteriorates further because energy prices are still coming down. Now, I'll just very quickly refresh. I think energy prices coming down is a good thing. For our finances, it's not because of the way the PCIA largely is structured, where PCIA charges go up. PG&E's contracts that they say they contracted on behalf of our customers are now more out of the money, right? They can be replaced with more cheaper energy now and other products. So the charge to us and our customers is going to be much higher. So the way we measure our financial strength, the metric we're using is days cash on hand, and we project that 5 years out. At December, we projected under the additional liquidity scenario assumptions, and I'll review those later in the presentation. We had projected 200, that now goes down to 142. Again, that has to do with the declining prices and the strain it puts on our gross margin or margin that we can charge our customers to remain competitive with PG&E. This is under the business as usual scenario that we remain competitive with PG&E, where we at least provide a minimum of 1% discount. Okay, so with declining prices, what you will notice now is that the budget significantly improves for this fiscal year. Don't be fooled. Basically, the gains in this year we're projecting will be erased by a further deterioration of margins next year. So why does that happen? Again, a quick refresh. The way PCIA and PG&E rates are set, right? There's a balancing account. When PG&E sets forecast PCIA rates and their own generation rates, it's based on market data that they have as of that time as to what the rates will be. Based on that forecast that the CPUC adopts and some prices that we call market price, it's called market price benchmark that the CPUC adopts, those are used to set the rates, PCIA and PG&E gen rates, right? Some nuances there. When those are set, when prices in right now have continued to come down. So what happens, PG&E is overcharging its customers because they use a higher forecast where prices are materializing right now. So that means customers are paying more than what PG&E should be charging. So that means next year's generation rate will come down even further. What happens to PCIA? So it's a double whammy for us, right? Their gen rate will come down. And then their PCIA will go up, right? Because now they're saying, okay, I was forecasting on a higher prices, so my above market cost was not that high. Now, with prices coming down, above market cost is much higher. So that's going to increase the PCIA. And we know this, and this is what we're building our reserves for, because we need to withstand these types of volatilities as well as many other elements that present volatility in our business. That's the reason for the reserves. And as we said, the reserves are what's getting us through this year while we are analyzing additional tools that we should have in our tool belt. That's the item next agenda item called the financial levers that Justin will go through. So the fiscal year 26 budget, we had forecasted withdrawing $60.5 million in reserves in December. That comes down to $12.5 million. Okay, why does it come down? As I said, because power price costs are coming down, and there's also a true impact better than what we had expected in our December forecast. The revenues actually, the final rates the CPUC adapted was slightly favorable to what we were forecasting because PG&E had took an aggressive stand. Value in the PCIA portfolio, there's batteries that were acquired for customers that are now departed, left to CCAs and other load serving entities. They're saying the batteries had zero value in the RA market. The UC said no. We're going to use the methodology that Edison, the big utility down in Southern California, used, and that basically provided on us a benefit of $20 million, showing 16 because there's some offsets and because we have some revenues that are indexed to market prices, and market prices coming down will bring that revenue down. That's why you see 16 million there. So the draw on reserves improves by 48 million. But I remember the balancing account I talked about. That tracking is going up. So that will come in and take a bite at us in the next fiscal year. So if you can see at the bottom there, fiscal year 27, we were projecting a draw of 81 million in the December budget. Now we're projecting a draw of 131 million. Okay, so 50 million, 48 million better, 50 million worse off. And again, this is with the movement in the battery valuation. So that's sort of the impact of the PCIA has on us, and this is the main story of this budget. Next, I'll just walk you through the key line item elements supporting this, some review. So you can see on this next slide, these are the main line items from the budget. You can see the revenues increasing by 16 million there. You can see a big drop in power supply. The other point I wanted to make in power supply is we have also reduced our hedging. In other words, the amount of prices we lock in before entering this year, for example. Part of the reason we do that is because we recognize this impact from the PCIA. So now with prices coming down, we let our power prices come down more so than it would otherwise would have. So this helps us in mitigating some of the next year's price increases, right? So it helps this year's budget, which again, cannot count on. I always say, always look at 2 years before it's not money in the bank because of this balancing accounts. It's a 2-year thing. You have a 2-year view you have to always have when making decisions on any net contribution to reserves. So that change in the way we're doing hedging on an estimated basis helps improve and soften the burden. But remember, the flip will also be true, right? Now, when prices increase, our budget is going to be much higher than what we project. We're not going to have those gains, large gains that we have in years where when prices increase, our bottom line increases. So there's no free lunch, it's hampering the risk so that we don't have too much extremes. And that's what hedging is. It's basically taking the extremes in outcomes and narrowing that down. The other items are relatively minor movements, in the budget, and they're detailed in the appendix slides as well as in the appendix of it. It's detailed in the staff report and in the appendix of the presentation. So the next slide shows you the rates. We were projected. The left shows what our projections were. You can see the PCI did not move; it slightly went up, and I just said the PCI evaluation, PG&E, the CPUC adjusted that valuation. You don't see that impact in our PCIA vintage. Remember, the year that people leave the PG&E system, PG&E basically takes a snapshot of the portfolio and says, okay, this is the portfolio your customers committed to, and we're going to mark to market, evaluate this set of assets with the market prices. And that's what your customers owe. By the time our customers mostly left 2017, so at that time, they did not have any battery storage. So we didn't see the benefit of the PCIA that later vintages would, but we do see an increase in the PG&E gen rate, which is improving our margin. Because now they were getting significant benefit, basically a transfer from unbundled customers to bundled customers with the PUC reversed. Now the PG&E gen rate is higher. And PG&E prevailed in their extreme position that they were taking. Okay. So here's the reserve projections that I talked about. Again, we introduced this scenario at the December budget. The business as usual, but with additional operating liquidity. What the additional operating liquidity is, again, very quickly I'll review the light and dark shades of bars here. The lighter shade, which is how we view our financial health at any given point in time, basically looks at all the funds that we have available, the board has available at its discretion to manage the business. And right now it includes a lot of allocated in the budget, but unspent program dollars towards our decarbonization, and that's in the tune of close to $100 million or so. So that makes the board can at any time change its decision as to how to spend money that hasn't been spent yet. That's what the light blue. The dark blue says if we were to take out that 100 million or so, all the what we call earmark funds, then that's the darker shade of blue. Normally, when we project 5 years, we say, all our earmark funds, we're going to be perfect. We're going to hit the bullseye. 5 years, those two bars will align. We're going to catch up. Our customers will catch up adopting our programs, and we will have spent all the earmark funds. But we're realizing we're still going to have some lag. So we conservatively budgeted 25 million. And the other is in operational flexibility. We always have contingencies or reserves, in our budgets, because we don't want to be bringing budgets because someone overspent one line item, right? And over a 5-year period, that adds up to be too much. So we're reducing our budget from a budget view, $6.5 million. And that's what we're calling this additional liquidity scenario, which is what we're measuring our financial health with. Okay, so that's the main highlights. Again, we are working on financial levers that started last year, and Justin's going to present that as the next item. The trend we've seen has continued and it's continuing. Prices are softening, but there's a lot of uncertainty out there. The critical period is the 2-year because of the balancing account. The good news is 2 years, the scenario I just described, we still remain above 350 days of cash on hand, which is our targeted cash on hand reserves. But over 5 years, as we've talked about in December, we don't want to generally fall below 250 days because of the risk we see in the business, as well as it's a number that one of the rating agencies said that is one of the elements that could trigger a downgrade for us if they see us falling below that level. And we are conducting additional financial stress test analysis. The last agenda item, Scott's going to walk through what we're proposing for this year's stress test, which we again will bring to the committee, plan to bring to the committee in May, bring to the board in June, which will further look at additional stresses that can materialize and how should we manage that and what adjustments to reserve targets and so on that we need to make. So that task will continue and will also be very informative for adopting the budget in September and December. That's the conclusion of my presentation on the media budget. And with that, if you had a chance to ask me any questions, we will ask that committee vote and recommend the adjusted budget with any adjustments.
Thank you. Any comments from the commission?
Can you go back to the summaries or the slide that showed the 48 million with the circle, please? Yeah. Okay. So what if there was a line underneath operating expenses with a subtotal? What we're looking at is what your net would be before your non-operating revenue.
So operating margin right there, 23 million that we're showing. That's
Look at the far left column, right? So if you take our operating margin, the negative 24,897, and you subtract our OpEx of 43,193, we would have been 68 million negative. And fortunately, the non-operating revenue, that's basically our interest on our
reserves.
cash, on our investments.
And the reserves we hold, yeah. Some of those, a good chunk of those are invested. Following our investment.
Right,
Yeah.
I don't care what it's on. It's that interest is on that's investment income. Okay. So that's, for lack of a better term, really saving us. But we've got a big negative number in there. And that you're saying that negative number is gonna continue into the future. This also has no strategy, no recovery of the GASB 62, right? The 100 million.
Do not distinguish that here. That's just an accounting distinction. So in the reserves, it's all in there.
Wait, yeah, yes and no. If you go forward one slide, and go forward one more, that one. Some CCAs will do their accounting and say the reserve amount, the 100 million in our rate stabilization, that could be considered in some CCAs, consider that a restricted cash, in which case you're looking at another difference in here, but
The dark blue.
the dark blue. So I guess what I'm seeing is, so here's my question / comment. We've got a number of different, let me say it differently. We are in a very fortunate position that we've been looking forward we've been anticipating the day when this is going to be cutting against us. The market is going to be cutting against us. And I think that what we need to do is always maintain that 1% discount. Because I think one of the most important things is to show to our credit rating agency that our customers are very sticky. They will stay with us. And that's not the situation with other CCAs. So I think that's everything that Amrit and the team are doing, the finance team are doing, is a good thing. That we're looking forward, we're doing the stress test, we're managing this. So budget always, if you make too much money, that you can be criticized for that. But if you don't make money, it's not criticism, that's just bad. So sorry, I'm complimenting you, and I'm saying that I think this is
prudent policy. We talked very early on, right? We needed reserves because this day was going to come, and we want to be competitive. We don't want to be short-sighted and give big discounts, knowing we don't have the ability to withstand these and the time it allows to make a decision, which is what we're doing, right? We're going through the financial levels analysis. One thing I'll say on the credit rating agency, yes, customer stickiness is very important. The financial stability is very important, and they also emphasize we want to see that the board set rates, and if pressed, they will bring in sufficient revenue, and whether that means charging above PG&E to maintain this financial stability. So that's something that they do emphasize.
Okay.
I have a question.
Yeah, sure.
Speaking to the stickiness, are customers sticky because they're forced to come here because of the way that many cities said you're automatically going to go to SVCE, or because of the 1%, or because they believe in clean energy?
So I think we're going to have a lot more discussion in the next agenda item on this very topic. So table it, or we can give you a brief response. I would give is we have a lot of C&I customers, and competitiveness is important.
Commercial.
So that's a big distinction between us and some of the other CCAs that we have to keep in mind. But we will go into depth.
Yeah, that's my suggestion, because Justin has a really nice presentation on that.
Okay, that's perfect.
In here, we just wanted to adopt a suggestion to adopt the mid-year adjusted budget.
Yeah, that's good. I'm just with all this bright and cheery forecast outlook. I'm just like, what are the things that have to be done or can be done, or can it be done to turn it around? And so I'll wait.
Okay, thank you. Do you have any questions? I had a couple of questions. Slide 6. The earmarks in 2930. I'm looking at the sidebar, side notes also.
What slide are you looking at?
Slide 6. That's the
The dark and the light.
Yeah, dark and the light one. It's about $19 million.
It's 25, as we said.
But then if you add this number,
So
subtract.
it's not exactly a million a day that we burn. It's slightly higher in that year. I think it's more like 1.3 million a day.
Okay.
So 25 divided by 1.3 hopefully gives you that difference.
No. The question I have is, how come the earmarks on the fifth year is much lower than 25, 26?
Because we're projecting our customers will all the programs that we have implemented and are deployed right now, there's a lag between customer. It takes time for them to learn about it and adopt them. Our forecast generally is that by Justin's forecast, in 5 years, that will catch up. What we're saying is we still want to, probably will assume we're not going to hit the bullseye. We have 25 million cushion in there.
Okay, so we are not expecting any new programs or anything?
The forecast assumes every year, based on the board policy, we allocate 2% of our revenues towards programs, and that continues. And these will again these are one of a lever that the board has. And that will be part of Justin's discussion.
Just to say, for several years, we put significant additional funding into programs. And so that's why in the near years, you see the delta is a lot bigger because we have a lot of unspent programs. But over the next few years, because we have increased our program deployment, we've got them all launched now, like we've spun up in response to all that additional funding. We will draw it down, which means by the end of the period, the delta becomes much smaller because we will have kind of gotten through the sort of additional surpluses and we'll be operating more, as Amrit said, on the kind of year-to-year delta or closer to that.
Okay. So the corollary of that is if you don't have any new program, the dark and light lines, light blue will be almost same, right? Exactly.
So if we don't have
new programs or anything.
then obviously that money would go to the bottom line and all of ours will go up.
Exactly. And then from slide 5, the previous slide to the 4th slide, this said, if you look at the arrow, the diagonal arrow, it's a revenue of plus 20 million. Where I don't see that.
Yeah.
Is that the net operating revenue?
So you see 16 million there in this slide, that you're looking at. But you don't see 20 million,
Right.
and the reason is we have some rates that are indexed to market prices, some of our custom deals. So as prices come down, revenues is going to go. It's not necessarily our margin because of the way those specific deals are structured. The revenues will come down. So the 20 million is somewhat offset by these other movements.
And then adding to Commissioner's comment, 20 million in the interest or non-operating expenses reduced our deficit, right? And then
And to date, returns have been very good.
right,
Fixed income
exactly.
market,
That was
but
my
it's coming down now, so
Right.
that's part of the adjustment. And also, I should note the committee, one topic I did not bring up, but we do in the stress test is the something called polar posting, provider of last resort at PG&E. So that requires posting of cash, and it's a very big topic. So when we do have to post cash, which we are projecting for this year will be higher, that gets to be restricted cash now. I cannot earn on it. So that also brings that down.
it's like the current accounts or whatever. And then just looking at this, what would be, I know it's difficult to project that, but then next year you said that our revenues will go down.
Yeah, if rates go down, there's variances of up and down. There's a slide. Let's do it as a forecast. Okay. So you can see the SVC, the dark blue there, SVC gen rate. So that's basically our weighted average projected rate. So that times load effect essentially is our revenue. So you can see there's up and down, but not where they have been in the past.
Can you walk us through this?
Yeah, thank you.
Okay. So the way we charge, this is assuming business as usual environment right now, right? So where we charge at least at a 1%
Just a sec.
discount.
In the estimated it's business as usual, to the left of that is historic.
Historical, thank you. Yes, left is historical. 26 on, left is business as usual, but that's what was materialized, right? We've always been charging, we've always been cheaper than PG&E, and you can see our discounts there that we've given in the past. The orange line there, SVCE generate discount versus PG&E. We're saying 26 onwards, we're forecasting 1%. That's what's baked into the 5-year projection. And then we can't, it's very difficult to predict PCIA and PG&E gen rates. We can't, even PG&E has 50% error rates between the forecast they put out in May and what the rates are at the end of the year. So you should understand all that uncertainty that's baked into these forecasts. And then, so that's a PCIA, and then PG&E gen rate, we forecast alongside with that. And then we give the discounts, we back out the PCIA so that our customers are on, if they were with PG&E, they're still 1% better being with us. And then the dark blue is basically the rate we would charge. And also shown at the table there.
So on the right-hand side, the 1%, that the orange line is what our discount is relative to PG&E. So from 2026 forward, you've modeled a 1% discount versus our actual discount has been greater, 1% or greater.
Yes. And also in the past few years, we've also been giving bill credits to low-income customers. That's about another 1%.
1% of our total?
1% of the revenues. And effectively, last year we set our discount there, general discount, says general 10%. In fact, in terms of finances, it's like giving 11% because of 1% we took as bill credits. So last year we gave about $17.50 in bill credits a month. This year it's $12. But in forecast going forward, just assume 1% discount. Either you can give it as bill credits to low income or 1% for all customers, but we're not assuming 2%.
And that big spike in 2025 that was 10%?
It's because remember the bill credits we gave in the summer, $50 to the rest customers, thereabouts.
Yeah. Do we expect more churn because we are suddenly reducing it from 10% to 1%?
Well, if you look at it from a customer perspective, they look at their total bill, right? There's that slide. So if you look at customer bases, their total bill, they look at total bill. They don't just look at our component of the bill, and Justin's gonna again go through a lot of this, is about a third or even less now of their total bill. PG&E's delivery and distribution charges is the big component of the rate. So you can see on a total bill basis, that's the impact. Like last year, RES customers on average, this is an average model customer, that they would have paid $206 something, and now they're going to pay $195 and something. Total rate basis. One more. Anyways, so the customer basically looks at that. So they're actually in a better financial position. They look at total bill, right? So that's a key thing. We cannot influence, we don't have that much of an impact on the customer's bill. So RES customers, they probably won't even notice. Like 1% is close to 50 cents or so, 55 cents a month. Their monthly bill, their impact on the bill. But for C&I customers, the big customers, they can care. It's big dollars for them.
I will say that I've been looking at other financial statements and credit ratings and what's going on in the market across CCAs in California. And there are several CCAs that are now at a premium to the PG&E rates. And the customers are not defecting significantly, but they are defecting. I spoke with a gentleman that has a small business in Santa Cruz County. And he said that he left 3CE because he just couldn't justify paying more money for his electricity. So I think it's very important that we have our 1% discount and we're doing the programs. So I'm supporting all the analysis, and it gets crazy complicated. I mean, if we can't understand all the numbers, can you imagine people that are getting their bill going like, I don't know what's going on here, you know? And it's the work. I'm looking forward to the next presentation because these financial levers are very important.
And then for me, yeah, when I look at my bill as a SVCE finance committee member, it's confusing. And then as you mentioned, the PG&E portion is so high, right? So I know other cities are looking at how to reduce that, talking to PG&E or trying to tell them to start their own. Anyway.
So we plan to bring something to the board in the future, just how to read your bill type of discussion.
Oh, that would be
I've heard about it from several different board members, so we'll plan something for maybe early summer.
That would be awesome. Public will definitely appreciate that.
From a customer perspective, we're gonna see should generate declining. So gonna see lower rates, right? So year over year.
Right. Even if they're with us or not,
Right.
but if they're with us and then their rates go down,
Yeah, so
even though it's a small percentage,
Right.
they'll still see their rates go down.
Yeah.
But our part is a small percentage.
Right.
Yeah, that's business as usual, but we have a next presentation that is might be prudent to start planning and
Yeah.
having some leverage in your pocket.
We have 2 more presentations,
Right,
Chair.
yeah. So before, any other comments from our commissioners? Okay, if not, I will open for public comment on this item. Item number 5. Any public in person or in remote wishing to speak on this item?
No hands raised, Chair.
Okay, thank you. I'll close public comment and then bring it back to the committee for any comments or motion.
Another action on this one.
It's right there. This is
If
next.
you're looking for a motion, I'll make a motion that we recommend to the Board of Directors that the Board of Directors adopt the proposed mid-year 2025-2026 adjusted operating budget.
Thank you. Thank you.
And we have Committee Member Squazzola has joined us, so I will do a roll call vote.
Okay.
Director Squazzola,
Aye.
Risto,
Aye.
Makachek,
Aye.
Srinivasan,
Hi,
Page.
Aye.
Thank you, that motion carries unanimously.
thank you. Thanks for a nice discussion on this item. Finance discussions are really interesting. So I move on to the next item, financial levers update, model scenario and reflecting feedback.
All right,
Okay.
thank you very much. Now, if I don't keep moving quickly, I will not be invited back to the FNA committee meeting. So I'm gonna move a little bit briskly, but there is a big topic, and mostly I'm doing that because I wanna make sure we have time to just have you ask questions or give comments. But if there's anything,
Need a couple of minutes for, he's bringing coffee, right? Or
No,
maybe-
I think he went to the restroom.
Oh,
I don't know what he's doing. Oh, did he go get coffee? We'll send somebody, staff person to get coffee.
Color
Yeah,
reading.
yeah.
I can wait.
Yeah, yes,
Maybe somebody can, Karen, could you go? That way you can come back to the meeting. And just so we know, we have another presentation after this one.
Yes.
So on stress tests, which usually takes us about
We should give it at least 15 minutes.
15 minutes.
Yeah, I think we are on schedule.
the juicy one that doesn't have.
Yeah. 30 minutes there, 20
Like I
minutes
said,
there.
I won't get invited back if I don't, but like,
You will, don't worry about it. So, we should be okay.
We have a quorum still.
Yeah, we have a quorum, but then we might be interested in that. Yeah, he's here. Go for it.
All right. Oh, there we go. Okay, so where we are in the process, just very briefly, sort of midway, I've had some
We waited for you.
introductory.
We waited for you.
Oh, I apologize.
I had some introductory presentations, but this is really a discussion point, trying to get feedback, bringing some additional information. We're going to do some recap, walk through some numbers, and talk about an example scenario. And I've got some kind of questions for us to talk through. But starting here, this is the same as Amrit's slide with the two bars. I've just dropped one of the bars and made it into a line. But you can see it's the same story as he just told you where we are, where the forecast shows that we're going, and kind of how that compares to our different reserve levels. And what we talked about back in December with the board was different levers, is what we called them, and kind of each one can individually do different things by the end of the scenario. But the goal is with these levers is you can kind of use them to slow or prevent some of the drawdown of reserves. And so it's a kind of a question of buying time or improving kind of the ending financial position of the forecast. We also talked about the SVCE mission, which is to reduce dependence on fossil fuels, and to do so by providing carbon-free, affordable, and reliable electricity and innovative programs for the communities that we serve. And we also talked about the value proposition, and I think based on some of the earlier questions, this may be something we'll talk a little bit more about. But this is both what we try to convey to our customers that we feel is our value proposition, and it's what we hear from customers in different contexts. So, you know, whether that's a customer coming by, which literally happened yesterday, to talk to Monica and myself to share his thoughts about the program that he went through and give us, you know, feedback and ideas. That is local control, that's local presence, that's something that customers can see and feel. We've talked about rates, we've talked about the investment in local programs and projects. We've talked about our very significant investment in building new clean power supply projects. These are all different parts of the value proposition. And got a bunch of feedback from the board in December as well. We had a special study session. I'm not going to read through this slide. This is kind of my effort to recap a lot of different really good feedback.
This is this from the workshop on 12/13?
Yes.
This is the one that we had over in Cupertino?
Yep.
Okay, I'm going back to my notes.
Yeah. Hopefully I've captured, you see your notes in there somewhere as well, but this is kind of the blend of feedback we've got. I would say the top bullet is kind of the overarching story, which is interest in balance, which makes sense. Okay, a little bit of new framing on this. This is a forecasted gen rate through the rest of our kind of 5-year forecast for what PG&E will be. So this is done in terms of cents per kilowatt hour. So this is kind of, you can imagine this is actually what's on the bill. And remember, there's another 30 cents that's on the T&D side. So as Amrit said, right now we're about a quarter of a customer bill. When you think about what that translates to in the SVCE gen rate, as Amrit went through, you take out the PCIA and the discount, and that kind of gets you to what we're actually charging. And that's the revenue side. So that is SVCE's revenue. On the cost side of the equation, you can also reflect our costs in terms of cents per kilowatt hour to try to make it line up. And that looks like this. So the bottom big category there is our, what I call the base supply cost, but it's really the costs that we have to incur in order to serve the load that we have and to comply with all the requirements that we have. And again, this is a forecast, so some of this This will definitely all change in some way, but this is the general shape of this. We have our operating expenses, we have the program spend. This is all sort of annualized so that we can actually compare it to the gen rate. And then we have the voluntary clean position, which is the more aggressive clean position that SVCE has taken on the power supply side.
We get more revenues for the
This is more like us going to 100% clean, not necessarily the green prime product. That's not
okay.
reflected.
And that voluntary clean, that's not the green prime
It's not green prime, that's
at
the
all.
green prime, as you said, we cover our costs to meet the green prime, so that's more of a wash. This is more the above minimum compliance, you can think of it for our overall Green Start product. So as you can see, that leaves this gap, right? This delta between the costs and the revenues, at least in the forecast, and that's what Amrit is showing. That is the drawdown in reserves, because there's a gap, and we're choosing to use our reserves to maintain our competitive discount on the left, but we do have the costs on the right. And that's the beauty of having the reserves. It buys us time, it buys us the ability to do that, to take this approach in response to volatility. That's why we have built those reserves over time. I also want to flag, and this came up earlier, that the gap isn't quite that big because we have done things like invested all of the reserves that we have, which provides additional income. And we've done the prepay, and that actually provides a pretty meaningful amount of savings towards this gap. So those are good things that we've done that are helping us now as we look at this gap. There's also a lot of uncertainty there because a lot of that is driven by the revenues side of that forecast. And so this is, again, that same red line, the base case, and then I've drawn some uncertainty bands around it, just trying to show that we don't know where exactly things are going to end up. This is our current best estimate on the forward look. But there are going to be moments where we learn new things about what's happening. So that could be a new ruling on PCIA or a new ruling on procurement orders or things like that that will give us more clarity as to where in the forecast we're going. So
just a sec.
Yeah.
The number at the left-hand side, the 600, 500, that's days cash on hand.
Mhm.
Is that the dark blue or the light blue?
This is the
The larger number
ending at 143, I think,
before program expenses,
leaving them in the
right? They earmarked, whatever.
Maybe we'll just.
We do show the programs being spent down. So the light blue
Yeah.
bar includes it spent down. But yes, this includes the allocated to programs but not yet spent numbers in the total.
Okay, sorry, I just wanted to put it in perspective as to which apples are the apples that we're
taller of the.
Yeah.
So, but really the story here is this is why, this is what the 5-year forecast looks like. There's a lot of uncertainty in the future of the forecast. And so there's a piece of this, which is we have time right now to make a decision, also to see where the future goes, because we don't know exactly where it's going to go. And then back to the value proposition. And I think we were talking about this earlier as well, which is, I'll just frame it this way. The whole value proposition is what makes SVCE competitive or not with PG&E, right? Like each part of this is part of why we are competitive, the way that we position ourselves, and it is how we want to make our customers sticky. So that was a comment earlier, and I think their customers are sticky today because sure they were opted to us, and so that helped us start at a very high level, but also we have been delivering on these things. We have been communicating that to customers. Some customers still have no idea that we exist.
Yeah.
Mhm.
Some do and are totally bought into this. Some really prioritize only one of these things, and that could be cost. And we have customers who tell us that, whether on the residential or non-residential side. We have some customers that are focused on the clean only, and that would be the main thing that they care about is are we clean or are we not, and that how does that look? So different customers have different priorities, but at the end of the day, it's sort of this blend that we look at. So when we think about the levers, if we were to move to a less clean product, it becomes harder for us to capture the clean power and the grid aspect of the value proposition. If we stop running local programs, it means that we're not really driving the local decarb transition, and also you don't really see the local reinvestment maybe in quite the same way as a customer. If we raise rates to at PG&E, above PG&E, you may not be able to say that we're competitive. It depends how you define competitive, because I think for some customers, slightly above PG&E, but getting the rest still sounds competitive. To some customers, it's lower or it's nothing, and that's the only way that they view sort of the competitive aspect. So
Just on that note, what I have seen in looking at other CCAs is they've said that they've moved away from a relative to PG&E rate to a cost-based rate. And that's how they're handling that item number 4, which I don't agree with, but you know.
Is it a compelling story to their customers?
I think their customers are confused. I mean,
Yeah.
you know, and they're having defections in customers, and the only thing, you have to read what they're doing, and then you have to read what the credit rating agencies are saying, their observations and their risks.
Yeah.
Um,
Can we maybe
Oh,
get through the presentation?
okay, sorry. Yeah.
And I just want to caveat that this discussion is about SVCE, and I understand that there's other CCAs and they all have different boards and different directives. We can't really speak to other CCAs and what motivates them in their performance. So I'd really like to focus discussion on SVCE, if that's okay, going forward. Keep going.
Okay. So I want to, one of the conclusions from the earlier slides, right? Actually, I'm just very briefly put back on this. This gap, this draw from reserves, if this forecast were to continue on into the future, what this would mean is at some point we would want to stop drawing from reserves, right?
Yeah.
And what this also shows you on the cost side is that the voluntary clean and the program, like there's not enough really to shed on the cost side to fully cover that gap. And so we're not in this position now, and we have a large reserve, so it's not what I'm trying to convey, but long term, it means if we had to, what we would have to do is raise the revenues, which means potentially increase the rates in order to match our costs. And that's what this shows under the current forecast, which has a lot of uncertainty. So thinking about that, if we were to take actions in the near term, let's say to try to slow down our draw from revenues by shedding some of our clean goals, shedding some of our programs, and we still got to a point where we had to raise rates at the end of this because the forecast just continues, this is what it looks like, we would risk being in a position where we kind of have a very limited value proposition. So that's just something to think about as we're making near-term decisions, how it will affect our long-term as well. So now very briefly, I'm going to describe this example scenario. What I put together is, okay, let's say we moved to a clean product. We kept our clean product, but we moved it to a 4% premium. For a residential customer, that would be about $2 increase per month. For a non-residential customer, they have a very wide spread of bills, right? It could be $2,000, it could be $100,000 a month. So it's about 1% of their bill, because again, we make up about a quarter of the overall electric bill. We could also create a new minimum compliance product, so it would be less clean than our current product, but we would keep it at a 1% discount to PG&E. And then essentially we would communicate this to customers and let them choose to opt down. So they would have this choice, do you want to stay where you are, even though there's a slight premium, or would you prefer to opt down? We would also reduce some of the program spend. And I just, for the purposes of doing the math, I said, let's start in 2027. So this has some benefits and drawbacks. I'm not gonna cover them right now. What's the impact of this? So again, that same red line at the bottom. And what happens is it would improve our final days cash on hand by about 75. And it would, interestingly, it would sort of shift in the topic of buying time, right? It kind of buys us, let's say, 1 year before we hit that 250 level, if that was a level you were trying to pin your reserves to. So that's how you can kind of think about a scenario. I also wrote down here what it would take. We would have to sell existing resources and positions that we have potentially. We would communicate to customers. We would keep pursuing deals with large loads to try to get them to commit to stay with us and create sort of rates and deals that work for both parties, et cetera. This aligns with the feedback from the board, but as you'll note, it doesn't fully close the gap, right? We're still showing a drawdown over time, but this might be something that would be a first step. We would learn some things about how customers react. Do they choose to opt down? I will note, as Monica said, we're different than other CCAs. We have different missions, we have different boards, we have different communities. I do want to note, San Jose did go above PG&E for a couple years before going back to being cheaper. And they marketed it to customers. They did the same thing where they had an opt-down rate, and they stayed at about 97% participation, which is roughly equivalent to where we are. And it doesn't sound like they even saw that many opt-downs. And so there's a piece of this where, we know what drives people, but also it's not a huge amount. And it sounds like people can be convinced by other parts of the value proposition of what we are. So I'm not saying that would be what we are. We have a different mix of customers. We have all these differences, but important to kind of think about those different ways that it could go, I should say. So what am I looking for today? Really, I think you'll all have your own kind of thoughts, reactions, questions. So I'm not even going to tee these up. I'm just going to turn it back to you and say, I think if you have any reactions to the example scenario, I'd love to hear that information you'd like to see, but otherwise, any kind of questions or comments, happy to get them.
Thank you. Thank you for the presentation and bring it back to the committee. Any questions, feedback, thoughts?
So if I'm PG&E, what am I doing to you? What's my next move against SVCE?
Speak to that. What's the question? What
If I'm PG&E, well, I think PG&E, regardless of us being in
Yeah.
the presence, I think PG&E is driven to try to improve affordability. And they've made that a very big priority. It's a priority of the governors, obviously. And so they're trying to do whatever they can to reduce costs. As Justin mentioned, 75% of your bill belongs to PG&E and distribution and transmission. A big portion of that, they really can't control because it's policy driven. Things like solar, NEM rates, and wildfire and public purpose programs. And then just like us, they're mandated to do a lot of clean energy through procurement, so they can't control that either. I think that everything they're doing is what they need to do as a business. Driving generation rates down essentially drives our generation rate down too, as you've seen, because we want to mirror what PG&E does. I don't think they're doing that to us. I think they're doing that because that's what they want to improve affordability. In terms of PCIA, that's all being held at the regulatory level right now. And so the CPUC, or the California Public Utility Commission, it has a proceeding open. We're supposed to maintain indifference. We're arguing our points, they're arguing their points. This may see itself in the legislative body, but I think, they're trying, I'm hoping that everybody's trying to work towards indifference and that the bundled customer is no better off or worse off than the unbundled customer, to our customers. I think that's what they should be doing, quite frankly, because that's what makes sense.
Are they trying to get our customers back? How hard, I should say, how hard are they trying?
I don't know. I couldn't speak to that, quite frankly, because a lot of those discussions we're not privy to and we don't know about it firsthand. But to Justin's point, we've maintained a 97%.
We're doing good.
Opt-in rate. Yeah.
That's why I want to know what do we think is the reason? There's reasons for everybody. Is it laziness because we're not going to switch? It's like
Why customers have stayed with us, Jesse. Yeah. So, and we do a survey every year, and we actually have one out on the street right now. And I think cost is a part of it, clean is a part of it. And I think the local piece actually really resonates both in a positive way where people like the idea of I can go by, or I can stop by the place, or I see you at our local art and wine festival, or whatever the thing is where we happen to be there. And I think there's a piece of it where PG&E does not have a great reputation.
I was going to say, the fact that we're not PG&E, I think makes a difference.
So I think those pieces are all part of it. But yeah, we'll see with the most recent survey also how that has changed, because I think the affordability piece has become much more talked about, largely because the T&D rates have almost doubled since 2019, I think, whereas the gen rate is basically the same where it was. So that's why we went from a third of the bill, or almost half at one point, to being a quarter, which hurts our ability to do anything to help on that front. And then I think the other piece of sort of stickiness in all of this is there is an energy that it takes to change, to call, to flip, to do whatever it is. And certainly, right now, historically, when we've been able to just essentially do all of these things under the financial conditions that we've been in, there's very little reason for anyone to want to switch. And I think moving forward, as long as we can keep conveying, and I think you mentioned this maybe in a board meeting, like part of our job is to help customers understand that we are delivering on this value proposition and why it matters to them, right? And I think that's something that we focus on and we do, but we want to keep doing more so that when they look at this and they think about it and they go, oh, am I paying $2 more? Let's say we did that example scenario, paying $2 more for SVCE. I love that. That's great. That's what I would want a customer to say because I see all the great things that I'm getting from that. And it's, I think, even if we convinced them of that, if I told them it was going to cost them $100 more a month, I think they'd say, well, I love SVCE, but I'm going to switch probably.
Yeah.
If I'm a residential
Everybody has
customer.
their number.
Yeah, it is.
But that level of energy for the value that they're getting, I think that really helps us because I think we are doing these things.
I think it's so important that everything other than price be the reason they stay. If price is the reason they stay, that's also gonna be the reason they leave. And at some point, it's gonna happen. And then we're in deeper trouble than we are. So we've got to find a way to get that, because the normal Joe on the street, and I talk to people all the time, and sometimes I say, hey, what do you think of SVC? And they're like, I don't know, I read that Santa Clara has cheaper power or whatever, they pick out some stupid thing, right? I know. So it's like, why don't you? I'm like, I just got there. I play stupid. It's easy for me to do.
It's only my third board meeting, I don't know.
Yeah, like, oh, I'm sorry.
No, I really like the way you said that too. If that's the reason they stay, then that would be the reason that they leave. I think that's true. I think you can probably say that about
Almost any
Clean or the
business.
other ones, but yeah, if we can deliver on the rest, that helps build the. Thank you.
Thank you. Any other?
Can you go back to the slide where you have the revenue and the costs?
Yes,
Please.
a bar chart, which shout out Scott for both the idea and the execution. I'm just here presenting it, but yeah, go ahead.
I was gonna say, this is one of the best slides I've ever seen at SVCE. So Scott, I'm looking at you, I'm complimenting you because your
That's all Justin.
collaboration.
That's Justin's artwork.
Well,
Hold on a second, but thank you.
the collaboration like that is really effective. You went the left side and, the growing of it then led us on. I think this
It's useful.
this is very useful and understanding what we're gonna do, because the realization that we have that gap is what Amrit is saying. So I think Amrit's projections and you're saying, okay, here's what we can do, or here's what all our alternatives are. We haven't got, anyways. This is all very well done. So
Thank you.
Can I add one just comment here too? And this is something that we haven't really talked about yet with the board or, every year we go through this annual budget process and we're going to kick it off again for next fiscal year. That operating expense, we're committed to looking at that, to doing a very deep dive and making sure that that operating expense reflects what it really takes to run this agency, and that where we can find savings, we'll make those savings and present that in the next fiscal year budget. Because I think we need to do our part on staff side as well.
No more coffee.
Yeah, sorry guys, you're gonna get the paper cups from now on. No, but since some of those operating expenses, right, are compliance mailings that we have to do, they're the payments we have to make for our data, like there's a ton of stuff that it takes, but as Monica said, we're committed to do that. And I also want to note, you can imagine in previous years, right, the way that this has changed is, let's say we've largely had the same cost, it's that the gen rate has been so much higher.
Yeah.
In 2025, the PG&E gen rate was 15 cents, I think was the number.
Yeah.
And PCIA was much smaller, and so the SVCE gen rate was almost double. It wasn't quite, but it's like because of that interplay, right? Where as the rate goes up, the PCIA shrinks, and so our effective point goes higher. And so then it's not a gap, it's a flips.
Yeah.
Where we're above, and that's where we get into the conversations we've had in previous years, where it's like, hey, when we have excess funds beyond what we thought, how do we invest them across rate discount, across program investment, across clean supply development? So it's just, this is driven also by the current financial forecast, and that's what we're looking at.
I know this isn't on our electricity cost, but I think as well, we, the SVC's staffs work on the procurement on the energy side and forecasting it. I think my impression is SVCE does that better than other CCAs. And we're focused on SVCE, but
We'll just say we do it best, no matter who you, there's no comparison, we
But we
just,
do it well.
we do it optimally, yeah, no.
no, I think that's something that SVCE has that's a step ahead, and that's to the benefit of our customers. And they're seeing that because my sense is that if we weren't doing that, our cost of power would be even higher.
I appreciate that, because that definitely is what we endeavor for, but I also would add that these procurement orders that we're getting from the state, including this new one, that we'll talk a little bit about at the board meeting next week for additional 6,000 megawatts across the board. Those create suboptimal procurement or decisions. And that will hit our bottom line. We're all subject to it.
Yep.
So there's no, but it strips away some flexibility from us to be able to build a portfolio that we think is sustainable and optimal. And so we try to fight them, but they happen anyway.
I think if you go to that last slide that you had that said, here's what you're looking at us for in the lower left, didn't it say ledge and reg?
Oh, yeah,
Yes.
those are part of our next steps, there's a lot of work on the ledge rich side, yeah.
That's pretty key. And that speaks to exactly what you just said.
And I think, on the procurement side, the third piece of the value proposition here, the clean power and the grid, I think that's also, we have found some really cool projects that we have supported and driven, the geothermal projects, the adding batteries to the Hanford plant. The board just recently brought, what was the compressed air thing? Like, these are all things where, again, we're embodying that third one. And that's independent of the exact emissions number or whatever the thing is. It's about pushing the state forward on the clean energy transition and kind of the thinking there. And I think that's what I'm not even on the team, so I can say I think our team does a really good job of that, of finding these important projects for the way the state needs to move. So, but how do we convey that to customers? How do we make sure that they see and feel and believe that? And we have a cool map on our website and things like that, but I think we can do even more to push that out and help them.
I'll give you another comment, gratuitous comment, that as Chuck mentioned, and I think others mentioned, to make a change takes a lot of effort. And does a dollar or two move the needle? Not really. At what point do you start to move the needle, right? But just being able to say, we're at a discount, it's like, okay, if it's $1 off my bill or $8 off my bill, whatever, people are frugal by nature, so, or many people are.
I can share anecdotally, having done research across the US on this topic, it's around a penny a kilowatt hour is when customers will pick up the phone. That's just generally in the retail electric space.
Yeah.
Then the other thing that you emphasized was C&I. Like, don't just think residential, because I tend to get trapped in the residential perspective.
Yep. And so that's something that we have to think carefully about. And I think we can think about multiple rate options and things like that too for different customer classes potentially, to try to make sure that we're being competitive while also delivering on our mission and all the things. But it's very important. We have 70% of our load on the non-residential side, and so that's very important for us.
Yeah.
Okay, I can feel Amrit staring at my back. So any other?
Yeah, I know.
My final comment is, well done.
Thank you. Do you have any comments? Okay, I have one question. I also wanted to bring up C&I customers because that's a major chunk, and then they are price sensitive than the residential customers because most of the residential may not read the bill properly, right? And then with T&D being the major chunk of the bill, they may not see the difference. The when you said in one of the slides, creating minimum compliance, how does it bring down the supply cost? Because supply cost, if you go back to that nice bar chart, yes.
It
this
would
one.
just be the voluntary clean slice up at the top there. And even that, there's some that we're in that we probably can't get out of, or wouldn't want to get out of. And over time, minimum compliance gets more and more stringent, right? It's like the state has rules about how we need to have more and more clean in the supply over time. And so even over time, that would shrink that voluntary clean piece and it would sort of fall into the base supply cost.
So right now, the state requires that our renewable portfolio standard get to 60% by 2030. Our board has adopted a policy that wants us to get to 75% by 2030. In addition to that, they want us to be 100% clean on an annual basis. So that means an additional 25% of our supply has to come from clean resources, whether they be renewable, like solar, wind, geothermal, or carbon-free, like large hydro and nuclear. So that's the difference, is we've set a target, the board has set an internal target to be better than the state requires.
Okay.
That's the difference in cost.
But somehow we don't communicate that, right? And saying that,
Yeah.
it's part of the clean energy, that bucket, but we don't say, hey, this is the target. Yeah.
And then to Justin's point, by 2045, by law, we all have to be 100% clean. We've just accelerated it here, and that costs us money.
So that is, it adds to the base cost plus, right? And
I think he's reflecting the base cost is only what is required by the state. The
okay.
stuff that he's calling voluntary
voluntary.
is that what the board has directed us to do.
Sounds good. Those are my comments, and then since I don't see any other thing, I open for public comment. Do we have any public wishing to speak on this item? Okay, it goes public comment, and then we'll get back to the committee for final thought or comments. If not, we move on to the next item, which is enterprise risk management and proposed stress test cases. Thank you very much.
Thank you all, appreciate it.
All right, I will try to keep this nice and tight. We'll see if there's much conversation. We know. We're going to talk about the stress testing today. You can go to the next slide. Amr, I don't know, did you want to do some of the upfront stuff?
No, go ahead. Go for it.
So the purpose here is informational. We'd like to have you understand the planning and budgeting process, kind of the underlying elements, and how that'll feed into future committee meetings. And we want you to seek feedback from you on the stress test cases that we're proposing. We prepare for the May-June timeframe for committee and board meetings. We're going to talk about 26, 27. So we're speaking to the future. We'll look over the ERM and the stress test cases, the key drivers, and some other scenarios we're looking at, as well as next steps. So the next slide. So typically we think about setting a budget for the year, which is that top step that helps us fulfill our mission. But before we get to a budget, the senior leadership team and many of these discussions with committees and so forth factor into strategic focus areas. And the way we identify those strategic focus areas in part is to evaluate risks and opportunities for the business to consider as it moves forward. Part of how we position the portfolio and our budget is in many ways a risk mitigating stance. So we can go to the next slide. So stress testing is part of enterprise risk management. So enterprise risk management is a comprehensive kind of organization-wide way that we identify what the current business climate is, if you will, be it market, regulatory, legislative, etc. We can't ensure that there's never risk, obviously, so we have to optimally manage it, and we need to identify where there's space for us to lean into opportunities. And those are some of the ways that Justin framed the levers, for example. Part of the ERM, or a component of the ERM, is stress testing. And so we want to understand both standalone risk as well as kind of the interrelatedness of risk. And when we model these, they're extreme but plausible is how we should think of them. So generally low probability, high impact, or high probability, medium impact events are going to kind of surface to the top, if you will, and we will then be looking at those intently to figure out how do we understand them and what do we do about them. It's really important for the nature of our business just on a commodity level, but there are many other factors that influence us as well as just the market overall. Go to the next slide. Every year we have a process where we work with the staff and especially the senior leadership team to identify and log items in what we call our risk register. And we encourage everyone to brainstorm there, not to hold back, but to identify all the things that could be considered risks. Then we take those and we push them against a rubric, and we say, okay, if these various risks have certain impacts to the business, as well as differing likelihoods, we kind of evaluate which ones are the ones that are the most pressing for the business in the near future. Typically, like I said, these are maybe high value but lower impact, or I'm sorry, higher impact but lower probability, and then others might have a medium sort of impact, but maybe the environment is that they're more likely to occur. And then from that, we identify a select few that we will actually do stress testing with through our modeling and carry through an evaluation of what the impact is ultimately on our liquidity and days cash on hand. So we'll talk about what some of those are, and as well as mention a few of the other risks that we don't intend to pick up as financial stresses on days cash on hand. So we go to the next slide. The three that we are, at the time of print for this presentation, the three that we are going to present are a price collapse. So as Justin mentioned in the levers discussion, the revenue side of our business is very volatile. And that's because power markets are volatile, and the power markets impact both the generation rate with PG&E and the PCIA. When market prices go down, the headroom or the space that's left for our competitive rate narrows. And so we're going to evaluate that, assuming a continued discount to PG&E approach. We're going to continue see what that stress looks like. Similar to what you saw in the days cash in hand projection, but it will be saying what happens if market prices continue to go down or go down further. We are going to have a stress case on the affordability focus. So there are many interests in this topic, and the degree to which we can or cannot do things to address this topic are, they differ. And so understanding the point at which we can or can't impacts how we might view the business overall. And then the last one is it's actually both an opportunity and a risk, which is that the PCIA is kind of going through these various tracks of review. And obviously CCAs are advocating for things with the CPUC that are beneficial to them. and the utilities are advocating for interpretations and rules and revisions that are favorable for them. So how it all falls out, we will have to wait and see. But we have great people working on it, and there's some upside, there's some downside potential. So we're gonna evaluate what that might look like, all else equal. The other two that I will mention that are actually somewhat nascent in the sense that the events triggering our thought to add to the stress cases happened after we prepared all this. One is the conflict in Iran and the implications on that. Just in Iran, I think it's Qatar, Alex Kraus and our team found some information just yesterday that that Qatar is cutting off LNG production and export, which is roughly 20% of all LNG in the global market. So that is like a beginning indicator of potential shifts that could drive up power prices, or ultimately after trickling through oil and gas and so forth. So we're evaluating that. We'll see how things shake out over the next weeks and months to decide if that needs to be added to this. As well, we are going to put a single case together that's a combination of things because of the procurement order that came out. And basically that is going to be, we comply with the procurement order, we buy additional PPAs. What happens if the actual load growth doesn't materialize that the procurement order is being predicated upon? So we're going to play that out, if you will, and just know what that looks like. Not saying that it's likely, but that it is definitely a high impact thing. So these are the stress cases that we're going to go down. I will touch on a couple on these a little bit more detail here on these next few slides. So maybe if you have questions, hold them till I give the further explanation. So on the next slide, the price collapse scenario is not just energy prices. It also is RA, resource adequacy, and attributes, RPS and GHG prices. Those declining have those effects through the business. They impact the PCIA and all the rate setting implications for us. They have challenges fundamentally if they are persistent. So the degree to which market prices for things go up and down because of short-term market impacts and volatility is one thing. The persistence of a state is a different thing. So if, for example, with the procurement order, market prices actually consistently stay lower because there's more renewables in the CAISO market, that is going to be a real persistent environment that we would sit in and need to understand. We will use our simulation models to determine the first percentile price level based on current market pricing and volatility in the market, mathematically, basically figure out what the market thinks the first percentile is. And then also we'll look at third-party provided fundamentals for RA and attribute prices. Those are less liquid. The market isn't very visible for those as to what the minimal levels are, but we have other data to help us with that. So we'll use those to define that. A reminder on the next slide is this concept of the generate and the PCIA and the fact that they behave in either an amplifying, well, let's just say they behave in an amplifying way one with another. So when market prices are high, we see higher gen rates and lower PCIAs, both of which are helpful for us. And when market prices are low, we see lower gen rates and higher PCIAs, which again compress that headroom. So you've probably seen this slide before, but it's just a reminder that these kind of behave in a fashion that exacerbate the stress, if you will, or dramatically alleviate it, as we've experienced for several years prior to 25. All right, the next slide should give us another view of this. And this is to remind you that these also have a true-up effect. So we're experiencing that now in the sense that our rates are lower because in 26 because of true ups from 25 because the rates were set at a certain level and the actual prices came in lower. So then the 26 prices get adjusted to true up for last year. And because we're seeing in next year the same impacts even more dramatically in 27 as an anticipated true up to 26, just given current market conditions. So the little grid here to highlight that there's kind of a delayed cascading effect from one year to another. When we talk about on the next slide, affordability, part of this is about what you were just discussing as part of Justin's presentation, the heightened importance of this in the minds of the public and through their elected officials and those who work for their benefit in government and so forth. So we think it's prudent to address it. It's one of the things that some of the members on the SLT raised as part of that process. It reaches into policy, political, environment, regulatory, legislative, and just our customers at very grassroots level. So we're going to do our best to understand what these pressures are and where they might channel discussion and results for expectations or desires of us as an agency. We're going to evaluate this both by itself as well as overlaying it with some of the other scenarios. And then the next slide jumps to the PCIA reopening. So PCIA as an acronym or as a math problem is one thing. It's a whole other thing. You actually talk about all the assets in the PG&E portfolio and all the interplay and so forth. Much of which is opaque to us. We can kind of like the wind. We can't see the wind, but we can see the effects of the wind. And so we see the effects both backward looking and we have consultants that help us have some sense of it forward looking. But we can't actually exactly figure out all the bits and pieces that are going on because it's rather intentionally opaque to us. And that's some of the discussion around the revamp. So if there's more visibility or changes in how the structure works, that could be beneficial for us in terms of how we manage the portfolio and the decisions we can make for our customers. If it becomes more opaque or doesn't really change much, there are impacts that we could see that we are not necessarily experiencing today that could exacerbate our view of how the generate and PCIA dynamics influence our business. So we're going to consider kind of all the implications of that and work it into actual dollars and cents to tell a story and carry it through for you to understand and see as a stress case. Next slide. There are a few other cases that were surfaced by the team that we're not going to put in as stress cases for a variety of reasons. Some of them are simply really hard to come up with actual number impacts. But they are things that I think are important for you to understand the team is actively aware of and doing things to mitigate them as part of their job every day. And so some of those things that have impacts on us that might be kind of non-monetary or maybe hard to put a number on for dollars and cents, things like other CCAs failing, the stranded costs with no recovery, which will come out a little bit in the procurement order, but is something that is hard to put a finger on entirely. That's basically that we have mandates to procure, but we don't get a PCIA like PG&E does. Potential reopening of direct access and how that it could influence the C&I customers that are with us, the large load question, what if there are data centers joining? And how would those get mitigated and what impact could they have? We do have risks, just vendor risk in general for any vendor we have, but there are some that are significant operationally, things like our billing systems or scheduling coordination vendors. Those things having interruptions for any reason, temporary or prolonged, are serious business risks for us. So the team is looking into those. Loss of program autonomy, if that were taken over by the state. Obviously, if you were on the audit committee, you heard Brett's presentation on cybersecurity. Good grades for that discussion, but there's always that risk. And then federal policy changes clearly can have an impact on us as we're in part experiencing right now as part of the California market. So those are the additional stresses. If we go to the next slide. I've kind of spoken to this already. We'll basically put these stresses together for you and present them to you later in the spring as kind of the monitoring part of it. Will be continuously evaluating these. We don't only take these risks in it once a year. We do it continuously. So, but we'll filter down to what we present you in the spring. And then the last slide is just next steps. So we'll present those stress cases to committee, I believe, in May, to the board in June. And then we'll use that to help inform the level of holdings that are appropriate for reserves. And then any of the other scenarios that anything updates or things that come to the top in these evaluations, we will be bringing to you then as well. Yeah, and then obviously all of this will eventually also factor into our shaping for our next year's budget. So that would be the last action item out of that. So, all right, I said a lot there. We only have 2 minutes left. Any question?
What I wanted to say is that unfortunately our chair had to leave a few minutes ago, so I'll be finishing this off. And I just wanted to jump out and say that what I'd like to do is just take public comment really quick so we can get that stroked off the list. If there's anyone here in person that would like to speak on this matter, please raise your hand. And if you're appearing remotely, please raise your virtual hand.
No hands raised, Chair.
I'll close, and no one's here wishing to speak. I'll close public comment on this and bring it back. You're looking for now questions, comments, feedback?
Yeah, if you have any questions, or if you want to provide any guidance if you really want to see something and it's not on the list, we certainly want your input before we start the analysis that we'll bring you in the spring.
I just want to ask, of the things that you left off, like, I was thinking about the influx of AI data centers, for example.
Yeah.
Which one of those things has the most likelihood of having the most impact on us? Of the things that you left off?
I would say, well, as Brett presented to the audit committee, cybersecurity issues could have a huge impact, and they're hard to put a finger on, right? That's probably one. I would say on a short-term basis, definitely operational system loss could have a huge impact on us. Again, you have to assume that there's a solution that doesn't sink you, but there's a big enough impact in the near term that it's pretty disruptive. So those would probably be the two that I would lose some sleep over, because they're maybe harder to control and have unknown impact. The rest of them are all things that kind of they kind of show up in the other stress tests, but they maybe don't warrant their own kind of financial evaluation.
Thanks.
Elliot, any questions, comments?
Thank you, Vice Chair. If I have any questions, I'll do it offline. Thank you so much.
Okay. I have a couple of questions. First of all, your photo on slide 7 was kind of interesting. The one in the lower right-hand corner.
You'll have to refresh me on which one that was.
That was the person looking at their computer screen as the graph goes way down.
Yeah. That's us, because we don't like we don't like low commodity prices at SVCE, so.
Customers like it.
Yeah, exactly.
Creates that headache that the gentleman is
So,
showing. The numbers.
Amrit, you referred to a cash requirement that could increase. I can't remember the name of it.
So actually, in our stress test,
Yeah.
the one we're gonna model and the one we have been modeling, we do have we actually used to explicitly call it COLA risk, but now we generalized it because proceedings went various ways in the CPUC. But we call it regulatory and legislative risk. But actually, we do stress the financial condition. Like, what if we had to give 2 months of our procurement cost in holdings? That's how we modeled it. So we do model it as an additional stress on liquidity.
Okay, but that wasn't mentioned in
it's
Scott's. It just.
So we have a lot of details that when we present the results, we'll have it.
Right, okay, so, sorry, go ahead,
I was
Scott.
just saying, to build on Amr's point, that's part of the stress testing, is those considerations on top of these cases. So that's kind of a foundational element to all of them.
Is that if market prices shoot up and generation rate stays low, it increases our obligation on what we have to post with PG&E. So when he shows the changes in market prices, it'll have consequences in other places in our operations, and that's what he'll show.
Right, but so in terms of if you're looking for some feedback as you're, just if you explicitly tie Amrit's comments to yours, just to, as a note or whatever, then say, okay, it eliminates my question.
Yes, they will be. And you'll see line items that show it as well.
Okay. And then the true up, that's a lag. The true up is always a lag, but that's something that we know of in advance. Is that correct?
We don't know, because that means I have to know what the prices are between now and the end of the year, right? So no one knows, and PG&E doesn't know, but PG&E tracks it. We don't know until they make an error filing. We'll have an estimate in May when they will issue an estimate that, again, as I said, the estimates can be very different from the final rates. And part of the reason we have more certainty on rates around mid-November is when the CPUC publishes market price benchmarks, then they true up all those balances. And then we get that data, which then gives us a more accurate forecast of January rate.
So do we have insight into what's happening with their memo account?
So we forecast on a weekly basis.
Okay.
IDIS here does that. So we look at where market prices are. We use a consultant model, NewGen. Again, the models, as I said, there's a lot of uncertainty. Even PG&E's numbers with perfect information, at least on their portfolio, PCIA holdings, they get it very wrong. But we model it nevertheless, because it's very forecasted trends. The trend we've seen in market prices bringing our financials down, we reported a year ago, right? We saw this. So we're getting the magnitudes, we're getting the directions right. We're not going to get the absolute number right until we get close to the rates.
Okay. Thank you. My other comment is, Scott, great presentation. Thank you. As I think of things, I think of there's headwinds and tailwinds, and some of those headwinds can become risks, but are strong headwinds. But so others are just kind of like, this isn't going in the right direction. It's not a problem today. Could be it's a headwind. It's going to hold you back. So I just wanted to mention that, and your comment on the natural gas is, that's something that's the LNG that could really be disruptive. So and it's hard to model that. So this is good. Although I didn't feel real great when you went through all those other risks and you're talking about that, because a lot of people don't understand how important, how volatile the energy market is, and it's all interconnected. And Anyways, so, well done. Go ahead.
Yeah, I have one question, which is just more out of curiosity. When we talk about the risk from data centers, is that there may be a huge consumption of PG&E's energy, or that we might end up with a customer who's a data center that all of a sudden that price differential is unsustainable because they need so much, or we can't provide their energy, or how does that impact Silicon Valley Clean Energy?
You wanna try, Scott, or do you want me to try?
I can let you try, and then Justin's there too.
Yeah, I just, at a very high level, if, like, our position is that if a customer comes into our service territory, we're the default provider. We will serve them if they pick us. Customer always has a choice. They can pick us or they can decide to go to PG&E, right? But we're the default provider. And so when we get a very large load and it has a very big demand, and that demand's gonna happen really fast, then we have to be able to procure for that. We have to be able to do the resource adequacy compliance products. We have to be able to procure sufficient clean energy for that new load as well. The slower the onboarding is of that load, the more time we have to make those commitments and to procure that stuff. The faster they come on, the harder it is for us to buy, but we'll buy it, right? So we have,
We are obliged to take them.
yeah, we are obliged to take them. They have the choice, right? And we'll give them a rate that reflects our costs and our contributions to margins and our risk and everything else. And so they'll make that decision. Now, the more kind of substantial risk is that this is really large load, theoretically. And without a lot of, if they don't make a commitment to us to be here for 10 years or whatever, and we're procuring long-term because that's our requirement under law is to procure long-term for a lot of clean resources, then now we have this new risk, right? And so we'll try, we're actually planning to bring something to the board probably in June-ish timeframe about a policy around large load and how to price and mitigate some of this risk associated with that. But yes, so unless we get a commitment from them, then we have this stranded asset risk, which is essentially
It's hard enough to meet the initial need, and then how do you maintain that if they say, oh no, we want PG&E?
So we'll set a rate to kind of recover to make sure that we keep all of our other customers whole. But I just have to say that this is not unique to data centers. This is for any new large load that comes into our service territory or load in general. Just the large makes it a bigger thing, and one customer leaving with a large load is more likely than 100 or a zillion customers leaving with a little bit of load, right? So that's why we're looking at it.
Thank you.
I'll also just add, we are capturing part of that risk in that one case that wasn't on the slide I mentioned, which is that there's now a procurement order for resources that we're obligated to buy. And if any variation from whatever is baked into the state's forecast for what loads will be in the state, any variation above or below that creates a difference between what we've been told go buy this and what comes in the door. And that could be because of what Monica even said, that they choose this to go with PG&E or some form of direct access or who knows what. And then we've gone out and bought. So there's some kind of interconnectedness there that makes that question even more important.
Thank you.
Other questions, comments, feedback? No? With that, I believe we are finished item 7 on the agenda. Committee staff remarks. Committee staff remarks? No? With that, we will adjourn the meeting at 12:10 p.m. Thank you very much.